Hi, everybody. Chris Englebert with Englebert Financial Advisors in Allentown, Pennsylvania, with the investment strategy update for April 2025. We're coming to you a little bit late, but we thought it would be timely. Last week, we were at an investment conference that turned out to be a great event to attend. We got a lot of good information, but we want to address the big elephant in the room. What's on investors' mind ever since last week when the tariffs were enacted or talked about being enacted? The question is going to be, or was, what's happening with the global economy and what's happening with tariffs? Well, what we wanted to address today is that you've heard about tariffs in the news ad nauseum for the last 5-6 days. And then yesterday was an event that we've never seen in our career here. Literally about 10:30, 11 o'clock, it came out that the tariffs were going to be suspended for everybody except China for 90 days. And we saw the S&P 500 rocket 10% on an intraday basis. Now, what's going on at our shop? Well, one of the things, if you've been watching our videos on a regular basis, you know that our risk indicators were elevated most of last year and especially into the fall. We began to dial down the risk in our clients' portfolios, either raising cash, moving to bonds, which were a great opportunity in December, or just taking defensive positions, obviously with some ETFs that are what's called an inverse ETF. Well, lo and behold, we have now seen, as of Monday and Tuesday, we have investment committee meetings here at Englebert Financial Advisors where we review all of our indicators. One of our best indicators, the 10-week bullish percent, literally got down to single digits, levels that we haven't seen since February of 2020 during the COVID sell-off. So our risk indicators are now extremely compressed. One of our strategies, which happens to be a tactical strategy that moves from cash to stocks to bonds, on Wednesday morning started to buy stocks. Now, one of the things that we're trying to be very opportunistic about is that you just don't rush all in and buy stocks. As I'm recording this video, the market's giving back some of that tremendous gain that we saw. But our risk indicators are so compressed right now with regards to the equity markets that we do see opportunities around out there at this time. Now, what's happening in the bond market? One of the things that we think caused the administration to suspend the tariffs for 90 days was the tremendous backup in interest rates. If you thought that the stock market was volatile, the bond market, the 10-year Treasury, literally went from a low of 3.9% in 3 trading sessions that I've circled here, all the way back up to 4.5%. So what does that mean as far as bonds go? If you've been listening to us the last couple of months, we think that bonds are valuable, and we were lengthening our duration back here at the beginning of the year when the 10-year Treasury was 475, 480. We did not lengthen our duration or buy longer term bonds when interest rates on the 10-year fell back down under 4%. We now think that bonds are of value again. So to kind of sum it up, both stocks and bonds are now back to being more of a value. What we think is going to happen in the next couple of days, weeks, and months is that this volatility is going to start to calm down as investors realize the longer term impacts of tariffs, which we can get to you in a later video. But what we thought was really a good time to review is something that we've been saying. If you've been a long-term client of ours, you've heard me say this several times. Those of you that are new clients of ours, these are my, I used to have 3 rules for creating wealth. I've just added a 4th rule for creating wealth. And I want to go over them here, so bear with me for a minute. So first of all, if you can't sell an investment and get your money out in one day, maybe you shouldn't own it. So there's a lot of products out there that people put their money in as far as annuity and insurance products that it's very difficult to get your money out of. Everything that we own at Englebert Financial Advisors for our clients, we can literally sell and send you a check the next day. Now, the second point is if you can't find the price on the internet. I used to say that in the newspaper. Obviously, nobody watches newspapers anymore. But if you can't find the price on the internet, obviously yahoo.com is one of the basic places that you can go to find the price of something. Maybe you shouldn't own it. And again, I think one of the most important things I see is that if it takes longer than a paragraph to explain what you own, maybe you don't want to own it. A lot of times I see people get into these very complex investments, guaranteed income annuities, indexed annuities, etc., buffered ETFs, buffered and structured notes, and they're really difficult to explain exactly what you own. And now my new observation I just added is that many people are really good at buying investments. They're not so good at selling. So in our practice here, we literally look at the markets on a daily basis. We have we have a program that we use that ranks, the strength of individual stocks, individual ETFs, individual mutual funds. And it tells us that when something is strong and everybody owning it, you want to continue to own it. However, for example, the Mag 7, we started to see last summer that there was deterioration in what's called the relative strength of the Mag 7. If you don't know what the Mag 7 is, Google it. I've also done videos on the Mag 7 as well, explaining it. So a lot of people fell in love with stocks like Nvidia, Tesla, Apple, Meta, etc. In fact, there was just not too long ago, about a month and a half ago, Facebook or Meta went up every single day for 20 days. Well, now what's happening is that when the market's adjusting, like it did with the sharp sell-off, we saw a lot of these over-owned stocks really get sold down hard because, again, investors and many people are good at buying stuff. There becomes a time when you want to sell or take profits out of something, and that's something that we practice in our registered investment advisory firm. So let me sum it up for April. After the sharp move up and down in the equity markets, we are reviewing all of our clients' portfolios to see how you were affected, how defensive we are. We feel very good if the market's down 15%, and I hate to say this, but if your account's only down 3, 4, 5%, 6%, you're doing really well. Our risk indicators have come down sharply, meaning equities are looking attractive, but we are picking our spots. We are still favoring dividend value stocks. They've come down much less than the general market, and also small mid-cap stocks, which we see an incredible value at right now. We've also gone to putting some international stocks and international dividend-paying ETFs in clients' portfolios because according to our asset class group scores, that's been one of the stronger areas to be in. Now, again, I talked about bond yields rising. We're taking advantage of that, lengthening duration. We actually think later this year, we began to see interest rates normalize and start to come down. But again, reach out to us if you have any questions about your portfolio. We are part of our process that we do in our practice is to review every client's portfolio and see how much risk they're taking and if they're in the appropriate level of risk, for their age and obviously situation. So that's it for the April update. We've had a lot of excitement. If you want to, feel free to pass this video on to friends that may not have a financial advisor. I had a couple of clients call me and ask me if that was okay. Absolutely. Anybody that we can help out, we're here for you. And again, feel free to reach out to us at any time. Thanks for watching. We'll be back next month. Let's see what happens.